All right, today we are going to look at a case study that demonstrates using a whole life insurance policy to buy real estate. What we'll focus on specifically is this. What do the numbers actually look like? Not the saying of you're earning a 6% dividend on your money and can borrow against it at 5%. That's nonsense because the dividend of 6% is a gross rate. It's not what we're actually earning. We're going to look at the net numbers. So what we'll look at is a case study based on a 45-year-old individual. He is going to fund a policy with a total of $500,000, but he'll do that over a short period of time. 5 years, that's $100,000 per year. After the 5th year, he pays zero in, not another penny. He wants to buy a property valued at $300,000. The loan interest rate on his policy is just over 5.5%, and he's interested in using his policy as his own bank or his own source of financing. He really wants to be able to use the cash value instead of going to a bank or purchasing the property in cash. And we'll look at the benefits of that. Firstly, he is going to pay the loan back, in this example, over 8 years. And what we'll look at specifically, we mentioned we'll look at the benefits. First, we'll look at how much money you're going to get from the insurance company in dividends and interest. So pretend that this 45-year-old individual is you. You're paying into a policy $100,000 per year for 5 years. What are you getting from the insurance company in total interest? And then when you borrow against this policy for real estate, how much are you going to pay the insurance company in loan interest? Because every time we take a loan, there is going to be loan interest. Let's look at the benefits to you and also the insurance company. We'll start with the basics, funding the policy. So again, 45 years old, he's funding it $100K per year for 5 years. When he's 50 years old, that's policy year 6. That's the first year he pays zero into the policy. How much does he have in cash value? $535,000. What's the death benefit? $1.8 million. So again, pretend this is you. You let the money sit and grow. When you are 58 years old, how much do you have? Just about $755,000 in cash value and still $1.8 million in death benefit. Eventually, that death benefit will go up. So now we want to take this policy and compare it with the same policy, but when we take loans. Here we go. A lot of columns going on. I'm going to walk you through this. So firstly, we take a policy loan in year 6 when I'm 50 years old here. $300,000, that's the amount of the property that I want to purchase. Now, when I take that loan, before we look at paying it back, what's the impact that it has on your policy? What's your cash value at age 50? $218,000. What's your death benefit? $1.5 million. How much did you borrow against the policy? $300,000. How much did your death benefit drop by? $300,000. How about your cash value? Did that drop by $300,000? A little bit more. It was $535,000. Now it's $218,000. The reason why is because the policy is also accounting for that loan interest next year of just over $16,000 in change. But when we borrow against the policy, we will see our cash value, think of it as your available equity, reduce. So you can still access another $218,000, but not the full $535,000 anymore. But it's still at work for you. You'll see that shortly. So he begins to repay the loan with $50,000 per year. So his net out of pocket is $50,000 per year at this point in time. Take note of the 2 columns to the right. In purple, that's how much of his $50K is being applied toward loan principal. And then to the right is how much is being applied toward loan interest every year. So you see $50K net out of pocket, and then how much is being applied toward the principal, and then also the loan interest. Now, after he pays that loan back, takes him 8 years, he's 58 years old, what's his cash value and death benefit? You can see it up top too. After the $300,000 loan is repaid, his cash value is $755,000, his death benefit's $1.8 million. What do you notice about the age 58 cash value and death benefit figures? They're the same. There's no change here at all. So here's why people are interested in using their policies or whole life insurance policies for real estate. I can put money into a policy. The cash value keeps on compounding when I take loans against it. So I'm compounding usually somewhere between 3 to 5 or 4 to 5%. Safe place to put money, liquid, very easy to access. And if I do it all right, I can access it tax-free all the way through too. So I've got that safe growth rate, the tax benefits, and the fact that it stays at work for me while I'm using it for something like real estate. That is a big point of attraction to a lot of people that like to use whole life insurance for real estate, business, and anything else that's going to earn a return for them. Now, with that said, while all of that sounds great, what should we be asking? Here it is. What is my cost to borrow? This is the question I would ask if I'm you. And what you can do specifically is compare the cash value growth and the loan interest cost. Remember what we said, we're going to look at the net numbers? Here's exactly what we're going to do. Cash value growth. Let's look at this first. So, year-to-year cash value growth. That's what we want to look at first. That column there, yearly cash value growth, is showing how much you're getting from the insurance company net year over year. So let's look at the worst year. The worst part about whole life insurance is the first year. You pay $100,000. This policy is juiced from maximum cash value. You've got about $92,000 in the first year, but that's a hit of almost $7,700 when we look at it. That's how much you lost in year one. Now you've got $92,000 in year one. If you add $100,000 to 92, what would you have? 192. What do you have when you look at this policy? 189. You did not get your full $100,000 back. You took a loss again. That right there, those 2 years are the drawback, or the biggest drawback of whole life insurance. Now year 3, you start to see I get my 100K back and some. So year-to-year cash value growth is isolating what you are getting from the insurance company net year over year. We're just looking at the dollar amount there. We could put a rate of return up to it too, but we're just going to look at dollars to keep things simple in this video. So that's your yearly cash value growth. Then we also have your total cash value growth. This one I like a little bit more because it's easier to calculate. A simple way to do it, look at the very bottom at year 15. How much have you paid into the policy? The column after the blue one. $500,000 total. You stopped payments after the 5th year. What's your cash value? $788,000. What's the difference between those two columns? It's on the far right, 288 and change. That is the total cash value growth. Everything above what you paid into the policy accounts for the growth or the total earnings you've received from the insurance company. So you've got your year-to-year growth and also your total growth. Now let's compare that with what you're paying to the insurance company, the loan interest cost. So we've got the year-to-year interest paid. What do you see here? Well, as we look at this, first year we pay interest in this example is year 7. How much did you pay that year? $16,680. As you pay the principal down, each year you pay less in loan interest. Next, you've got the total loan interest paid. So this tallies up the interest you've paid every year and adds it all together. I really like this column because a lot of times when we look at an interest rate with any product, say you have a mortgage, maybe you got a mortgage that was at 3% back in the day. I say back in the day because interest rates are higher now. You were told the interest rate is 3%, yet when you looked at your statement, it feels like you're paying a whole lot more than 3%. Well, that's because of how the interest works on a 30-year mortgage or mortgage with a bank. So with this, we can simply see what am I paying in total interest? And then once I've got that, I can compare it with what the policy is growing by each year or my cash value growth. Let's look at the yearly cash value growth and the yearly loan interest first. So the year-to-year cash value growth, if we look at year 7, it's about $24,000. What did you pay in loan interest? $16,680. You're ahead. You're in the black there. However, we can make this look not so good. What would happen if you took a $300,000 loan in year 4? Because year 4, you could borrow $300,000. If you borrowed $300,000, the cost would still be that $16,680 in this example. You earned $73.75. My point is, we always want to look at what our money is growing by and compare that with what we're paying in loan interest. This way we don't think that we're always coming out ahead, because that won't always be the case. So this compares the yearly cash value growth with the yearly interest paid, and then we've got our totals. There we go. By year 15, the total cash value earned, $288,000 and change. The total interest paid, $75,000 and change. So this right here is what I really like to show individuals that are actively using their policies or plan to actively use their policies for real estate, for their business, or for anything. This way I can see the numbers with transparency, and I don't get myself into a situation where I find out that I'm actually in the red, but I thought I was in the black. It happens a lot, believe it or not. And it's really just helping to make everything clear, because when you look at a life insurance illustration, it can be confusing if you're not even thinking about taking loans. When you add loans, it makes it really confusing. So we like to look at those illustrations, but then also create reports like this just to make things a bit more simple. So I do hope that this made sense. Let us know if you have any questions at all, and thanks so much for watching. Have a great day. Thanks again.